We are expecting another decision from the Federal Reserve Wednesday on interest rates. Just 2 weeks ago, Fed Chair Jerome Powell suggested the central bank could hike rates even higher than previously projected. But a lot has changed since then, especially in the banking industry. The recent collapse of 3 banks and the financial industry rescue of 2 others is complicating what the Fed does next. Meanwhile, Treasury Secretary Janet Yellen on Tuesday pledged more support from the government to safeguard the banking system.
Our intervention was necessary to protect the broader U.S. banking system, and similar actions could be warranted if smaller institutions suffered deposit runs that pose the risk of contagion. The situation is stabilizing, and the U.S. banking system remains sound.
For more, Mark Zandi joins me. He's the chief economist at Moody's Analytics. Mark, before the collapse of Silicon Valley Bank, everyone expected the Fed to raise rates. Now there is debate about whether the Fed should in a fragile banking environment. Can you explain what the trade-offs is that the Fed would be wrestling? And is there a real debate, or is it pretty clear what the Fed's going to do?
Sure, John. The Fed's in a tough spot. Before the banking crisis that began about 10 days ago, the Fed was focused exclusively on getting inflation back down. So that meant raising interest rates to slow the economy's growth rate to quell inflationary pressures. And they've been doing that for about a year very aggressively. Now the banking crisis puts a lot of pressure on the banking system. And that would argue for no rate hikes, that, higher interest rates, particularly higher short-term interest rates, higher federal funds rate, the rate the Fed controls, would put pressure on the banks because it raises their cost of funds. It makes it more costly for them to raise the money that they need to go out and make a loan. So, the Fed has to make a decision. What's their priority? Is it inflation, or is it making sure the financial system is on solid ground? That's a very difficult choice. My sense is the consensus at this point is the Fed's going to split the difference. Before this mess in the banking system, they were thought to likely increase rates by 0.5 point. Now I expect them to raise rates by about 1/4 point. If I were on the Fed, I might do something different, but I think that's likely what they would do. Will do tomorrow.
Well, Mark, don't keep us in suspense. Tell us what you would do, and then let me tag on to that. What do you make of the argument that if the Fed did pause, that would send a signal, oh, my gosh, it's worse than we thought. The Fed's not raising rates. It must really be bad in the banking system, which would obviously do the opposite of what a rate pause would intend.
Yeah, no, good point. But I think that their priority should be at this point to make sure that the banking system, the financial system broadly, is on very solid ground, that there is no question here. And literally last week, they were setting up a credit facility to provide liquidity to the banks. That is cash to the banks so that they can go out and pay depositors. And now this week, they're going to turn around and raise interest rates. That's very incongruous. It just doesn't fit for me. So I would be focused on the financial stability priority. Now, it's a judgment, how people would react to that. You make the point that, maybe people get nervous that, oh, wow, the Fed's got to pause and therefore the banking system is in worse shape. But the banking system is fragile. Everybody knows it. We had deposit runs. I don't think it's any surprise that the banking system is under pressure. So let's fess up to it and let's make sure that the system is on solid ground. I think it is. I think what the FDIC and the Treasury and the Federal Reserve have done is adequate, but let's just make sure. And by the way, what's the cost of doing that? Maybe you delay a few weeks and raise rates and then go back to fighting inflation if financial systems on solid ground. So, in my view, I would be focused like a laser beam on financial stability, nail that down, and then let's move back to getting inflation back in.
Do you think any of this turmoil in the banking system or the confidence shudder that went through the economy will do anything to growth? In other words, might it dampen economic activity and therefore actually do what the Fed's trying to do with its rate increases anyway?
Yeah. Great point. That's an excellent point. Absolutely, it's going to have an impact. I mean, small and mid-sized banks, and when I say that, those are banks with less than $250 billion in assets. So Silicon Valley Bank, for context, had a couple $100 billion in assets. They account for half of all the loans that banks make to businesses, half of all the consumer loans, 2/3 of the residential mortgage loans, 3/4 of all the commercial real estate loans. So they're a big part of the credit that goes from the banking system to households and businesses. And credit that's key. That's the mother's milk of economic activity. You need credit to grow and expand. And that's going to be restricted now because the small and mid-sized banks are under a lot of pressure. So that's going to slow growth significantly, unclear how much. And that's also going to weigh on inflation. So you're absolutely right. That's effectively a rate increase right there. The Fed, maybe 2, maybe 3 rate increases. We don't really know. So that's another good argument for saying, hey, let's just pause a little bit here, take a look around on the other side of this and see, where things stand with regard to the economy, inflation, and make a decision, down the road about raising rates again.
Last question for you, Mark. It seems weird to go back to something Powell said before all of this banking stuff, but recently in his testimony in the Senate, Chairman Powell talked about how things were going to get bumpy after the Fed made its moves. What does bumpy mean to you? And is what we've seen in the banking industry, is that essentially what bumpy looks like?
That's what bumpy looks like. That's exactly right. It's, that when you raise interest rates and you raise them as fast as the Fed has and as high as they have over the past year, things are going to start to wobble and break, and it's going to feel uncomfortable. And this is what we saw in the banking system over the last 10 days is exactly what he was talking about. It's going to get bumpy. And I don't think it's over. I mean, inflation is still high. The Fed's still got to get inflation back in. And so the next 12, 18 months are going to be uncomfortable.
All right, Mark Zandi, we appreciate you being with us, and we'll be with you many times in the next 12 to 18 months. We appreciate it again. Thanks, Mark.
Take care now, John.